Welcome back to the Global Payments Advisory Group Conference, Home Edition. We hope you enjoyed and benefited from our discussions of yesterday. For day 2, we have 2 topics lined up. A panel discussion on sustainability and corporate responsibility at Wells Fargo, and a spotlight on operating in a post-COVID-19 global business environment. We will conclude the day with an open dialogue and live Q&A for both topics. At any time, please email your questions to the panelists at globalpaymentsadvisorygroup@wellsfargo.com. Thank you for joining. I will now turn it over to April Fraser, Head of Banks at Wells Fargo, to moderate our first session.
Hi, welcome everybody to another GPAG event. Thank you for being here. We're going to kick off a panel today for sustainability and corporate responsibility at Wells Fargo. I'm April Fraser, Head of Banks for the Corporate Investment Banking platform, and really want to thank each and every one of you for your relationships that we have and the partnerships that we have had for over the years and everything that we've been through throughout 2020. And I hope all of you are doing well and staying healthy during this time. I have 2 colleagues that are joining me for the panel today, Mary and Genevieve. Mary, I'm going to turn it over to you to introduce yourself.
Hi, this is Mary Wenzel, and it's great to be here with you today. I lead our sustainability and corporate responsibility team here at Wells Fargo. Our role is to really work to ensure that sustainability is embedded throughout the organization, and also that we are transparent in our reporting and disclosure on important ESG matters. Genevieve?
Thanks, Mary, and thank you, April. I'm happy to be here as well. My name is Genevieve Pichet. I lead our new ESG Solutions Group within Corporate and Investment Banking. Previously, I was responsible for our asset management sector within financial institutions and worked alongside April. Thanks for having me today.
Well, thank you, Mary and Genevieve, for being with us today. There's so much going on in the world of ESG and sustainability, especially in every country you can think of. And so as a leading global financial services company, Wells Fargo is committed to helping address social, economic, and environmental challenges. The panel discussion will highlight our company-wide focus, the opportunities delivered to our clients, impact-oriented priorities, and how the bank is adjusting its model to deliver the full suite of thought leadership and products in sustainable and ESG investing universe. I wanted to pull a few stats today just to try to help everybody really bring it together on why are we talking about this topic and why is it coming up in every conversation that we're having with our clients. First off, ESG investments is topping over $1 trillion already today. And if you couldn't pick the better quote from anybody, it's really from BlackRock's chief executive, Larry Fink. He recently said, "Climate change has become a defining factor in companies' long-term prospects. Last September, when millions of people took the streets to demand action on climate change, many of them emphasized the significant and lasting impact that it will have on economic growth and prosperity, a risk that markets to date have been slower to reflect. But awareness is rapidly changing, and I believe we are on the edge of a fundamental reshaping of finance." And so with that, Mary, I'd love to start with you. Can you tell us a little bit about the evolution of social impact and sustainability at Wells Fargo over the last several years?
Sure, happy to do that, April. And it has been quite a journey. I joined Wells Fargo in 2004, and we set our first sustainable finance commitment in 2005. And we really didn't know what the opportunities would be for us as a company, and we figured we could do $1 billion of sustainable finance safely over a 5-year time frame. We reset that commitment in 2018 to achieve $200 billion in sustainable finance by 2030. And we're well on target to meet that commitment because we know our customers expect us to support them in their own sustainability journeys. Our employees want to work for a company that's aligned to their own values. Our investors want to see us really seizing these opportunities and managing ESG risks in the right ways. And so it's been a great journey, and the journey's really been one of these are nice things to do to these are things we have to do to be successful as a company and to support our clients in the right way.
And as you look at it too, I mean, as a lot is changing, how do you see that Wells Fargo is looking at investing on the sustainable track? I mean, it's great to have Genevieve in her role now, but as you think about it in your seat, and we've been focused on it for 5 years, but you probably don't hear a lot about Wells Fargo. Where do you see our current focus today as it relates to sustainability?
Absolutely. Our stakeholders expect us to address important societal challenges. And our stakeholders expect us to have a responsibility to all of our stakeholders, from our investors to our employees, to our customers, to our suppliers, to our communities. That really was the impetus for the Business Roundtable statement on corporate purpose. So if we believe as a company that we have a broader set of responsibilities to our stakeholders, we really want to prioritize those challenges that we, through our business, can address. And some of those are helping close the racial wealth gap, really focusing on advancing diversity, equity, and inclusion, supporting the transition to a low-carbon economy. What can we do through our financing and investments to really drive and accelerate progress? And lastly, economic inclusion. How do we, through our products and services, bring more people into the financial mainstream? That's really the priorities we have today as a company and where we think we can have the most impact.
And so Genevieve, you have recently moved into a new role, which is really exciting for you individually as well as for us as a firm. And we've been seeing this with a lot of our peers and a lot of the clients in the banking sector, that you can't just be thinking about it from a broad corporate responsibility as an overall institution, but really bringing it down to the lines of business. And so as you bring together the ESG solutions team, what is your focus today? What are you most excited about? And how do you see working with our clients across the board?
Yeah, thanks, April. Wells Fargo has such an amazing opportunity to fully tackle this issue with our client base. And the corporate and investment bank at Wells has a very special value proposition, which is that we have we bank the components of necessary of an effective ESG process. So ESG really has stemmed out of the asset management community to a great degree over the last several years. And in my previous role as the head of our asset management corporate investment banking sector, the themes of ESG permeated more and more of our conversations. And it became apparent that all of the capital that was being deployed and being managed by the asset management community needed a place to go. And simultaneously, our own client base, which spreads across multiple industries across the country, really it's a global platform, but especially here in the United States over the last 12 months, there has been a new sense of urgency by corporate issuers and our own clients to start incorporating sustainability into its own practices. And this is coming from employees, it's coming from the management teams, it's coming from their stakeholders and their communities, all of whom are saying, in the time of COVID, it's been an opportunity for self-reflection. And it's also spurred a lot of discussion around the stability and resiliency of companies through disruptions like this. The civil rights movements in the United States has really further exacerbated the conversation and created a sense of urgency that corporations and companies and banks have the ability to influence the dialogue and create some change. And at Wells Fargo, we sit in between. We sit between our clients and a lot of the investment community. And we have the balance sheet and the product machinery to really create pretty dynamic change and spur conversations and advise our clients on how to advance their priorities. And I would say that while my responsibility is new and the group is new at Wells Fargo, we're doing this work for a long time. And ESG is a very holistic sort of risk-based approach that really will benefit from creativity across industries and sectors. But we've been doing it in silos for a long time. Wells Fargo was was book runner on 40% of the high-grade sustainable bonds done in the U.S. this year. We have, through our corporate public finance team, we are #1 in ESG munis. We were a lead on the Ford Foundation bond this year, which was a groundbreaking transaction that was awarded Bond Buyer ESG Bond of the Year this year, which was a great success. And we have done some transactions there for the Alabama Public Schools, as well as the Los Angeles County Public Works for the benefit of the LA Museum, which was a green bond. So there has been a ton of work. We also have a leading real estate platform where there has been a tremendous amount of work on multifamily housing, LEED certified financings, and there's a lot of opportunity there. And then finally, we have one of the largest energy businesses of any bank in the US. And as part of that, we have a renewables team that is actually sharing its expertise and helping guide our public utilities and our power companies into a new generation of their own life cycle. So we have a lot to leverage, and what we're trying to do is bring it all together.
Yeah, I mean, you hit on a lot of things, Genevieve. I mean, as we've come together as a corporate investment bank, which is now one of the 5 business lines of Wells Fargo, I think there's just so much opportunity to bring the coverage teams, the capital markets teams, both from an equity and a DCM perspective, and really bring that expertise to the table. And, you know, Mary, I'd be curious from your perspective, right? So Genevieve brought up the dynamic of COVID, changing the thoughts of how we're thinking about sustainability. Has anything changed at Wells Fargo with how we think about it from the top of the house with the dynamics of COVID and the social impacts that are happening currently?
Absolutely. You know, this is the year of the S. For a long time, ESG investors didn't know how to measure and evaluate S performance very well in companies. And our response to COVID, how we've supported our customers, how we've supported our employees, all the steps we've taken to keep customers financially sound, to keep employees and customers safe, have been critically important in our journey to rebuild our reputation as a company. And we've gotten tremendous feedback from stakeholders as we engage and share everything we're doing around COVID and around supporting our customers. This year, we announced that we were donating the gross proceeds from the PPP fund to support distressed small businesses. So we created a program called Open for Business that we're funding to really help small businesses, particularly diverse small businesses, which have been hardest hit under COVID, survive this economic downturn. And so it's given us, I think, a new mission and mandate in a way to really focus on how we support our employees in the right way, how we help drive sustainability economically in our communities and with our customers. So it's been a good journey for us to focus on the S in a really powerful and impactful way.
Thanks, Mary. And that really brings it back to you, Genevieve. I mean, S has become the new norm. Over the last several weeks, we've seen multiple social bonds that have hit the market. And so as you bring together this ESG solutions team, which is very new at Wells Fargo, you know, what are your first steps that you're going to take at? What do you see as the go forward plan of action for this team, and how we can be, you know, really helpful to our clients and partner with other banks as well?
Yeah, this work is absolutely fascinating. In a sense, you're taking a grand existential dilemma and problem, and you know, we have the ability to break it down into the discrete pieces that we can influence within our organization. And I think that, you know, the ESG Solutions Group at Wells is going to evolve very quickly, just as the whole landscape is evolving very quickly. But I would envision us over time doing a number of things. So I would say one of the really important pieces of ESG is really the risk component of it. And over time, incorporating ESG concepts into our own risk methodologies. We have spoken to many partners who are doing this work, and they have indicated that banks can spend, are really important in this process because they have the ability to deploy capital at the right price and in the right structures to the right opportunities. And when you think about that, that's really a risk concept. And so over the next, several months, we're going to be rolling up our sleeves and really understanding the ESG considerations within our own client base, understand the needs of the investors and the risk management teams at our clients, just to start to, really get our arms around what that means in practice as we deploy capital or we try to allocate, marry up capital in the capital markets. I also envision us innovating. So, product innovation is something that's going to be really important, and it's going to be creative. I think I had used that word earlier. So, creative is something that does play a big role in the ESG world, because ESG is not just one thing, it's many things, and trying to bring that all together and coming up with new structures in the capital markets or in lending or in liquidity solutions will be something that we're going to focus on. I think ultimately we're a client-centric business, and we're going to spend a lot of time listening to our clients. And over time, we want to have all of the right tools to provide top-notch advice to them on how to achieve their own objectives around ESG, and be very thoughtful and innovative in the way that we discuss capital and solutions with them. And it will range across lending and debt capital markets and the equity capital markets, as well as M&A, cash management, liquidity, and so on. And then I think it'll be really important for us to partner with Mary's team and our enterprise as they respond to external stakeholders like our regulators, our own shareholders, or even our relationship with government organizations, and make sure that we're responsive to the enterprise objectives and support the enterprise as they formulate a strategy that is actionable and within the realm of possibility for Wells Fargo.
Yeah, thank you, Genevieve. These challenges we're talking about, climate change, racial inequities, economic issues like affordable housing and small business growth, these are issues that really require companies like Wells Fargo to use all of its levers to drive change and have positive impact. From what we're doing in our philanthropic investments to what we're doing in our own operations, to how our lines of business are really supporting these priorities. It's going to be critically important to actually be able to enable change and to show progress in addressing these challenges. So I'm excited to work with Genevieve and the business, and I think we're going to really have some measurable outcomes to talk about.
Yeah, and Mary, along those lines, in April, to answer your question a little bit about our banks, prior to my role in asset management, I covered banks, and so I have been very close to that space as well. And I think what is fascinating to watch is how our bank partners and are thinking about this, and we are we can see much to sort of model ourselves against, and there are best practices in the industry. We are clients all over the world are being problem solvers in this space, and I think together as a global financial community we can learn from each other and ultimately make a tremendous amount of impact on a global scale. So, I think that it's there's a lot of reciprocity, there's a lot of information sharing, and there's also a great camaraderie to know that we're all in this together.
And you hit on it a little bit there, Genevieve, is when you think about the international landscape, that it definitely feels that the U.S. has been a little bit more far behind, right? And so a lot of the banks we have out there in the audience are international banks. And I think you're right that we could learn a lot from what we've seen in other markets, specifically from a European perspective, where they've definitely been advancing on this at a much higher level, where we've seen a lot of different ESG solutions teams come together. As we think about, obviously, we can't leave today without mentioning the election and how things are potentially changing. I mean, Mary, as you think about where things could happen in the U.S., and as we talk to banks around the world, we feel that we're a little bit behind. How do you see it from a government perspective? Where do you see the U.S. going, and how long is it going to take for us to really play catch up a little bit here with the Europeans?
So I think we've always seen leadership at the state and local level on sustainability issues. The focus on and attention to those issues has varied at the federal level, but I think we've always known, working with state and local officials, that sustainability is critically important. I think, frankly, the interesting dynamic is that if society at large doesn't feel like the government is paying attention to these issues, their expectations are that companies pay attention to these issues, right? It's not that these issues aren't important. They don't decrease importance. It's just a matter of who's taking the leadership position at a moment in time. Certainly, we know the Biden administration is much more assertive on needing to address climate change and some of the topics we've talked about today. And so we expect to see kind of more policies and positions and frankly, dialogue on climate frameworks.
Yeah, that's helpful, Marian. I know there's been a lot of conversations, as you mentioned, the regulatory side as well. Are there things that could change on how the regulators think about it? I know internally at multiple banks, looking at different ways of looking at internal capital if you're really thinking about kind of the ESG standards and being more sustainable. Well, I want to thank both of you for being with us today, and thanks for the audience for being with us as well during our first GPAG virtual event. But I think some of the key highlights that we want to share here is that, Wells Fargo is really invested. We are looking at really making sure from a sustainability perspective that we're doing what we need to do, not only for our shareholders and our employees, but also for all of our customers, that we really touch to the depths of the United States, as both Genevieve and Mary pointed out. And really excited to have Genevieve in her new seat with ESG Solutions. And we're really looking forward to seeing all of you, hopefully in 2021, and bringing Genevieve with us to really share in the practices that we can and hear how all of you have learned from the international side. So again, just want to thank all of you. Look forward to seeing some of you in the Q&A sessions that we're going to have. And now I'm going to turn it back over to Ashish for our next panel. So thank you again.
Welcome, and thank you for joining our second panel discussion for today. The topic is operating in a post-COVID-19 global business environment. The COVID-19 pandemic has delivered perhaps the greatest challenge globally. We all work towards safety of our families, teams, and customers as our top priority. It also spurred businesses to take new approaches and act rapidly. For example, Wells Fargo was able to smoothly transition more than 250,000 staff to work from home within days of taking the decision to close offices. Banks also quickly implemented digital tools such as document sharing, digital signatures on loan documents, and supported government stimulus programs and safely, securely handling of stimulus payments to taxpayers. But economic, trade, and other challenges remain, forcing companies and individuals to adapt to this new reality. I'm thrilled to have a panel of experts who will present their perspectives on the impact of COVID-19 and the near to medium term implications on the economic and business environment. They will also highlight the expected future ramifications on global trade, business continuity, and how banks adjust in a post-pandemic world. Let me now introduce our panelists. Jay Bryson, Managing Director and Chief Economist at Wells Fargo. Jay is speaking to us from Charlotte, North Carolina. And from London, we have Ravi Hanspal, Principal for Commercial and Transaction Banking at Boston Consulting Group. Crystal Kennedy from New York is Business Continuity and Resiliency Leader at Wells Fargo. We are also delighted that two leaders from our relationships in Malaysia and Australia have joined us. From Kuala Lumpur, Raja Teh Maimuna, Managing Director of Wholesale Banking AmBank Group. And from Sydney, Michael Lim, Head of Sales, Financial Institutions and Transaction Banking at ANZ Bank. I'm going to begin our discussion today with you, Jay. How do you see the economic environment and outlook?
Well, thanks, Ashish. So if we can have the first slide here that shows the U.S. GDP growth. And this just go back a little bit. I mean, obviously, back in the second quarter, growth in the United States just collapsed when we went into lockdown mode with COVID. But, as you can see, we also bounced significantly there in the third quarter. Growth in the third quarter at an annualized rate was over 30%. Now, we're not going to continue to grow at that point. We think here in the fourth quarter, we're looking at growth in the order of maybe, 5% or something like that. But, the point is, we believe the U.S. will probably continue to grow under the assumption that the economy doesn't have to completely lock down again. When you go to the Eurozone, though, and go to your next chart, I mean, you see something very, very similar, right? A big collapse in the second quarter. The economy came roaring back in the third quarter, but unfortunately, whereas the United States probably continues to grow in the fourth quarter, the Eurozone is probably going to contract modestly in the fourth quarter. Obviously, we've had just big reacceleration of COVID cases there. Many economies in the Eurozone have implemented restrictions again, not to the same extent that we were in the spring, but we are looking for somewhat of a contraction here in the fourth quarter with a rebound next year as a vaccine becomes more widely available. And then when you go to China as well, the next chart, same sort of thing. China went into lockdown mode. It was one of the major economies to first do that. So the first quarter was quite weak in China, bounced in the second quarter, and growth has held up relatively well so far this year in China. And we think that will probably continue. There's very, very few COVID cases in China now. Now, I would be remiss if I didn't warn people that as we saw in Europe, COVID can come roaring back very quickly. But so far, it looks like China is escaping the worst of that right now. And so we would expect that the Chinese economy would continue to grow. Now, one thing to keep in mind, and this chart, this point becomes very relevant in the next chart. Here I'm showing you the level of activity. I'm comparing the United States to the Eurozone. And this chart, as you can see, goes back to 2010. And we index everything to the fourth quarter of last year equals 100. We're doing that just so you can see percent changes. And what's striking here is both the United States and the Eurozone, as I had mentioned earlier, those economies collapsed in the second quarter, came roaring back in the third. But as you can see, the size of both economies are smaller today than they were at the peak in the fourth quarter of 2019. And it's going to be, frankly, quite some time before we get back there. We don't think here in the United States it will be until the end of 2021 when we get back to that previous peak. And in the Eurozone, given the fact that they're going to contract again, it looks like, it's probably not going to be in some time until 2022. So the good news is we've come back. The bad news is that we still are in a COVID-induced hole in many of these economies. And that brings up the next point, and that's chart number 6, is that the outlook still is dependent very much on the evolution of this pandemic. If you look at this is the cumulative cases, the darker the blue is in this graph, the more of cases there are. And what stands out is the United States there on the left part. It's a little bit more difficult to see Europe, but again, most European countries are blue as well. Now, the good news is that there is a vaccine that has been developed and looks like it's going to be effective, and that will be rolled out hopefully sometime next year. But it's kind of a little bit of a race against time. As we've seen in Europe, cases have accelerated tremendously. They have accelerated here in the United States. And so we hope we don't have to lock down before the vaccine becomes widely available. And so we'll see, right? That's a big unknown at this point. So the good news is as you look into 2021, the further out you go, the better the outlook should become, the more widely available this vaccine is. But in the near term, it looks like the risk would be skewed to the downside if a lot of economies have to go back into lockdown mode because of a real acceleration. When you look at globally, we've talked about individual economies at this point. When you look globally, here on chart number 7, you can kind of see the time series here in terms of global growth. What really stands out is that blue bar. That's our estimate of global GDP growth in 2020. It looks like the global economy is going to contract around 4% or so in 2020. You can see a small negative bar there during the Great Recession of 2009, but it clearly pales in comparison. As we go forward for 2021, you're looking at a growth rate probably on the order of 5%, maybe as much as 6%. But I think, it's coming off of a low base. It's a bounce. But as you go forward, if you go back to the first decade of this century, you had a number of years in which global GDP growth was 5% or more. That's probably just not going to happen. Again, that was China joining the WTO and really becoming part of the global economy. That was Eastern Europe really becoming part of the global economy. Those ships have sailed. And so what we'll, I think, most likely look at as we go past 2021 is growth rates kind of on the order of its long-term average of roughly 3.5% or so. One thing that central banks are doing around the world, if you go to your next chart, they have expanded their balance sheets tremendously. The Bank of England recently kicked up its quantitative easing purchases. We think it's very likely that the ECB will do so, and the Federal Reserve could also do that as well, at least here in the near term. And so what that means on chart number 9 is, looking at 10-year government bond yields here, they've been depressed for quite some time, and they probably will remain depressed for the foreseeable future. In short, we are in a low interest rate world right now, and that will probably continue for quite some time. 2 longer term things to kind of keep in mind here before I end. On chart number 10, what I'm showing you here is Chinese population growth. If you look at the dark line, that's the total population in China. This shows you annual average growth rates, goes back to 1980. As we all know, growth in China, population growth in China has slowed. You see that here. And then as you go forward to 2040, you can see negative growth further out. But what's a little bit more concerning is if you look at the blue line, that's the growth in the working age population. That's where the economic growth rate comes from. That's negative right now, and that's going to continue to be negative. So whereas back in the days, China was growing 10% per year, that's never ever going to happen again, at least not on a sustained basis. And then the final thought that I would leave you with is on our final chart here. Here I'm showing you global industrial production growth. So that would be the blue line, and then the dark line is growth in global trade. If you go back to the 90s and the first decade of this century, global trade was growing about twice as much as global activity. This was the age of globalization. When you look at the last decade, you can see those 2 lines have grown roughly the same rate. And that's probably going to likely happen as well. Maybe globalization comes back a little bit, but we're not going back, we don't think, back to the 90s or the first part of this century. And so what that means is global trade volumes will probably grow only in single digits rather than the double-digit pace that we were accustomed to back in the 90s and the first part of this century.
So Ravi, Jay ended his remarks by stating global trade growth may likely remain lackluster for the foreseeable future. BCG had done a great paper on redrawing the map of global trade post-COVID-19. Would you share your BCG's views on the future of trade?
Sure, an absolute pleasure. And I'm pleased to say that I don't think anything I'll say will completely disagree with what Jay mentioned, which is all good for the consistency of the panel. So if we could go to the next slide, please. So in short, yes, look, COVID-19 is going to have quite a material impact on trade, but even beyond COVID-19, we really are seeing some of the greatest shifts in the pattern of trade we've seen for many years. So obviously starting with the COVID pandemic, what this is doing is driving a substantial supply and demand shock to trade. But I suppose a more subtle factor that not everyone's sort of talking about is how COVID is also encouraging businesses to rethink how they run their supply chain model and their business models. Now, the supply shock from COVID really comes from the fact that supply chains just paused, particularly during the harshest lockdowns we saw more towards March, April, and May, and the inability to manufacture and ship goods. But at the same time, we're also seeing probably a much longer demand shock from weakened consumer confidence amid all this uncertainty and hardship. And I guess sort of one of the key factors is actually the full impact of COVID-19 on trade hasn't necessarily been seen. So given the amount of emergency government funding at really all ends of the supply chain by many governments across the world, we might actually only see some of these impacts further in 2021, given, I suppose, in inverted commas, artificial funding in the supply chain. Secondly, of course, geopolitics also sort of continues to be a factor in trade. And we really are at a time when there's quite a lot of tensions around the globe. So US-China, for example, has really not just reduced trade in some degrees, but also starting to change patterns, for example, increase in ASEAN trade. The UK departure from the EU will potentially cause some trade changes in UK manufacturing, the relationship with Europe and export patterns, as well as the formation of other trade deals. And actually, this is likely to all impact trade in some way, some positive, some negative, for many years to come. And again, it's not just the volume of trade we're talking about, but the patterns. So where we see trade moving and how the whole map of trade looks like, which I'll go into shortly. And then supply chains were starting to evolve pre-pandemic and clearly will be affected by the pandemic, geopolitics and innovation as well. And what we're going to see is a real movement from these very globalized supply chains to more local and multi-local supply chains as businesses start to de-risk. And then if we think about Industry 4.0, that can actually change how supply chains work. For example, we hear quite a lot of case studies about how spare parts for heavy industrial equipment were 3D printed when basically the world stopped from COVID. And then of course, climate risk is going to change trade in a degree. So if you look at the EU and their carbon border tax, that changes priorities for importers and exporters. But at the same time, how do we make supply chains sustainable? Is the trade-offs where things need to be local versus imported from across the world, is that all going to change? And how will that impact priorities and as well as the economics of trade? So if we look at COVID more, I suppose, more specifically, as I mentioned, we're seeing both this concurrent supply shock and demand shock. And I suppose this is why we see such a big impact. I think overall, we expect the 2020 impact on trade to be about 10% on global trade goods. And what drives the supply shock? Well, in many countries around the world, in fact, most countries now, the government had a period of lockdown, but actually that continued well beyond just a few months, in the sense that there are some sort of restrictions in many countries for many months, and they're still ongoing, as well as this threat of another lockdown we're seeing in many parts of Europe. So what this did is it closed factories, but also exacerbated supply chains. So in the sense that many manufacturing sites would be closed across the world, but the probability of having a country where all manufacturing sites in a global supply chain were open at any time in the first half of this year were actually quite slim. So even if one country was recovering, we noticed that if parts of the supply chain were closed off, suddenly the trade would dry up. In addition, there's the concern of workforce absences, sickness, disruption of distribution, stalled ships, flights banned, the economics of actually cargo flights changing because there were no passengers. All of that really made the supply quite difficult. Clearly, what does this do? Low inventories, reduced income, and sort of vicious cycle of missed and delayed payments, negative cash flow. On the demand side, however, we also see sort of closures of spending outlets, shops and restaurants all closed. They have supply chains, reduced industrial output as people, as low demand for intermediate goods, travel restrictions and closures, job losses, investment losses for people who invest in the stock market, pensions, etc., and quite weak consumer confidence, but also industrial demand for commodities, manufactured goods, etc. I suppose one thing worth pointing out, though, is a lot of people, particularly on the ground, those not involved in trade, sort of felt that the whole world stopped because of COVID. You look around in Manhattan in the middle of probably May, everything's shut. It looks like the end of the world in a sense. But we do have to remember that almost gives an overly negative view of the impact on trade, because yes, we can't go to restaurants, we couldn't go to shops, we couldn't go to cinemas, theaters, holiday, whatever. But a lot of that is actually service revenue and domestic revenue. So to a degree, trade is fairly immune to that. And therefore, when we start looking at the impact of trade, as I said, maybe 10% down in 2020, but not 50% down like some industries might suffer. If you go to the next page, please. So if we look at a few examples of how supply chains are changing, again, a lot of this was pre-COVID, and in a sense, COVID will just accelerate some of these strategies and changes. So for example, what we see is a lot of US-China supply chains changing. So a lot of goods that were shipped to the US that were produced in China are now produced in ASEAN markets. So Vietnam, Thailand, seeing quite a big jump in production. But at the same time, there's almost this geopolitical diversification in the sense that sort of very high IP related goods, such as complex patented pharma, is being produced more and more in the US. And I think the trend we're seeing is that a lot of supply chains are changing in terms of actually, just going to the lowest cost markets is no longer the sole factor in determining where to locate your primary manufacturing sites. And if you go to the next slide as well, we're seeing that it's not actually just the corporates driving this, but there's a lot of government intervention. Again, it's more protectionist behaviors, both due to sort of public health side of political pressures, but also trying to ensure that investment stays stable in a lot of these markets, given some of the real hardship seen at the start of the year. And again, so some very common examples, stuff like restrictions on medical supplies, France banning the export of certain substances. But at the same time, we're also seeing a lot of push towards local agriculture, more self-sufficiency, as countries really try to de-risk or geographically de-risk their economies. If you go to the next slide, please. So if we sum this up, I guess we see three different models of how we're going to see trade change. And sort of number one is global supply chains. They will stay. They'll be very commonplace, and I don't think sort of anybody BCG side is denying that. But what we do think is there'll be a lot more redundancy built into the process. A lot of organizations realize that you can no longer sort of rely on a supply chain with key bottlenecks, which are susceptible to geopolitical, but also sort of natural disasters and other factors. So what we might see is what we call migrated supply chains. We'll actually see this shift. And I think the prime example here is the shift from Chinese to ASEAN manufacturing, the shift into the US. So there's less geopolitical, but also, again, I suppose, meteorological risk exposure. But then what we plan to see a lot more of is localized and regionalized supply chains. So supply chains moving closer to the end consumer, not just for risk in terms of politics, but also government incentives for local manufacturing, as well as what we might see is the ability to more economically produce goods nearer the consumer. Now, what this can do is speed up vertical production. And actually, so if you look at fast fashion, this is quite a trend, but also combine that with Industry 4.0, the right machinery, actually human capital becomes far less important a factor, or the cost of labor, and to be more specific, becomes less important a factor in where you plan to build your supply chain. So if you go forward one more page, if that's okay. So overall, we've done, and I suppose this has fed a lot of our analysis, quite a lot of sort of modeling about the future of trade. And this is an exercise BCG does every year where we run a trade model to really understand sort of by commodity, by corridor, where do we expect trade to go across different scenarios about 10 years forward. And what we see is that number one, we roughly expect, and actually WTO data is suggesting that it's going to be about bang on, about a 10% reduction in global goods trade in 2020. But then going forward, what does this mean for recovery? And I suppose just as Jay mentioned, sort of mid to low or low to mid single figure growth through 2029. And what we've done is sort of built three different scenarios. So we call this bull, base, and bear. And what they're really modeled on is a bull case is what we expect to be a sort of a V-shape recovery in the economy, so effectively return to prior growth. A base case, which is kind of a V or more of an extended U, so quite a drop, but then that will recover quite stably. And then a bear case, which is called basically the economy doesn't recover. And really the cause of this would be if the vaccine doesn't work and 2020 happens again and again and again. And actually, you move to a model where for the next 5 years, there's a lockdown of several months each year, which of course will be very, very disruptive. And clearly, hopefully doesn't happen. So in each case, what do we say? Well, roughly we're saying that we get back to 2019 levels at late 2022, 2023. And I suppose one of the more interesting factors sort of in some of our modeling that's changed actually relatively recently is that 2021 might actually take quite a hit. So even if we successfully make it out of 2020, the fact that a lot of government funding would start to dry up, far fewer individuals would be having government-sponsored subsidized wages. The economy would kind of need to stand on its 2 feet. And when that happens, the money might dry up for certain sort of struggling businesses, which again would see actually quite a sharp decline. So I guess 2021 is really a year to watch, and I think that will spread what we see the future of the economy to be like.
Thank you, Ravi. So with the economic and trade perspectives provided by Jay and Ravi, let us shift our focus to how banks navigated in the COVID-19 environment and the post-pandemic implications. Crystal, how did Wells Fargo handle and adjust its approach towards business continuity and resiliency efforts?
Thank you, Ashish, and thank you for giving me the opportunity to speak today. We've heard from the regulators consistently over the past few years about the concept of business resiliency and how it differs from business continuity. So we think of business continuity as preparedness for a business disruption, whether that be technology, a civil disruption, or something like the pandemic and COVID. Whereas resiliency is really not only being prepared, but also trying to prevent a disruption from happening. And lots of institutions in the financial industry are expected to migrate more towards that position. From an incident management perspective and COVID, it's been very clear that every organization has needed to really be more agile in adapting to scenarios. Of course, no one or no company would have thought of a pandemic for this elongated period with the impacts that COVID-19 has had on the global environment. We here at Wells Fargo are continuing to enhance our model and are changing to what we like to call a hub and spoke business where, we have a very tight control at the core, particularly for escalated events such as COVID-19. When COVID really started in March of this year, we had, Wells Fargo had a relatively new CEO in Charlie Scharf. He had been here for about 5 or 6 months, and a brand new COO, and myself actually, who had only been here for about 3 months. And as we were getting to know the organization, it became very clear to us again that this strong command and control was the way that we needed to proceed through that. And we coordinated our efforts that way and continue to do so today. At the forefront of our minds was clearly employee safety and getting as many people home as possible. That factor came into various discussions when we were thinking about opening our branches, and if we were opening our branches, what were the physical protocols that needed to be in place to do so, and which branches, of course, that we could close. The concept of getting essential employees to the office, essential only employees to the office, was absolutely critical for us. And we were able to get to approximately 70% of our colleagues able to work remotely by about mid-April. And, you know, half of that 30% are really our branch colleagues in the field today. You know, Ravi talked a lot about the supply chain and the impacts of the supply chain. Wells was certainly impacted by that as well. And we talked about resiliency. You know, we actually thought very early about things like sanitizer and the mask supply across the globe and to our employees. Things like the plexiglass that we were going to need to reconfigure our branches and our offices, filters, things of that nature. And, you know, we actually had to adjust our supply chain internally to account for that. And make sure that we were staying ahead of it and ordering ample supplies. And if an organization, a global organization such as the size and span of Wells Fargo, was having difficulty getting some supplies at some points during the pandemic, it really stresses the need for preparedness going forward. So in addition to, you know, all of that activity and making very crucial decisions around who was going to the office and who was not going to the office. Again, all of that being coordinated essentially with our operating committee, who were, you know, our CEO, Charlie Sharp, and all of his direct reports. We also recognized that frequent communication was very important to our colleagues. And we very much so got into a very strong rhythm with very frequent updates going out across the enterprise from the office of the COO with COVID-19 updates, talking about the planning that we were doing, the efforts that were underway, and you know, guiding colleagues around new ways of working. We found that, and we've surveyed our employees, we found that we were actually very effective in our communications. Standardizing data. So, you know, one of the big challenges we had in our COVID planning was really getting good standardized data across the enterprise. And the call centers are probably the easiest example of that. So when you think about, you know, your banking call center and your home lending call center, you know, they're on potentially different technologies with different service levels, et cetera. And really able to present a good dashboard for our operating committee was absolutely a challenge for us, but ultimately we were able to get that in place. The other key thing that we stood up very early that was absolutely key to enabling such a quick access to work from home was a group called it was a cross-functional risk steering committee called the Cross Daily Decision Response Group. I think it was called the CDDR, and that CDDR was with you know, various risk stripes, so liquidity, you know, market, enterprise, operational risk, you know, all of the risk stripes, and really intended to be a quick decision vehicle for any policy exceptions, and also as a stopgap to make sure that before we were sending folks at home, which no one had ever contemplated that we would send 70% of our workforce at home, that we were doing it in a very controlled and well-postured from a risk perspective manner across the enterprise. And that proved to be very, very effective for us. Everyone knew they had to go through that toll gate before they were able to work at home, and we continue to monitor those policy exceptions that are granted to this day. You know, again, back to the supply chain, if I could, when we decided to move people home, it was very evident that we were going to need to take desktops from the office. And in order to do that very quickly and effectively, you know, we needed to order monitors, cables, you know, mice, headsets for our call centers. Headsets actually became quite a challenge for us. And not only did we need to change the way we procured those materials, but also the way we distributed it internally within the office. We set up distribution centers around the globe to pick up those mass quantities, you know, for our colleagues to pick up mass quantities, because at this time, many of them were not even in the office, and those were things that were intended to fix them. The other piece that, you know, I'd just like to bring up is, in addition to, you know, all of that planning around getting to the office, setting up a quick risk environment, making sure that we had good operational metrics, and transparency for our operating committee, then we started to talk about returning to office, right, and getting back to office, which, we're still in that stance today. We developed a safety control framework. We've developed a return to office framework that looks not only at just our facility preparedness, but also, the local and public health statutes, as well as, statuses. And again, making sure that we have the right mechanisms in place to control a safe work environment, employee safety being key in all of the decisions we've made. We've actually taken advantage of, folks not being in the office to reconfigure some of our back office states to make sure that we are socially distancing. When we do return, we've certainly done things, as many have, relative to what I call the plexiglass, improve the filters, et cetera. We're standing up some technology in order to help colleagues know what time to come back, particularly for elevator access and things of that nature. So a lot of activity is going on around returning to office. And then finally, from an incident perspective, I'd like to just note that, the George Floyd protests in the United States in the early summer, in the June timeframe, were certainly, unheard of. And certainly challenging from working in a COVID stance with 70% of our colleagues at home. And we stood up some very protocols during that time around, proactive things like boarding our branches, et cetera, as well as, branch closings, ATM limits, and things of that nature, looking at our, capital and our markets, et cetera, and making sure that things were stable. Those protocols were absolutely very helpful for us as we thought about, as we proceeded through the presidential election in November.
Thank you, Crystal. Now let me kick it off to Rajate. Rajate, how did AmBank adjust its operating model to support workflow and SME clients during the pandemic early days?
Hi, Ashish. It was quite a mess at the start because the country went into lockdown on March 18. So that was a full national lockdown, meaning that no one could move around, and we had to very quickly institute our BCPs, split our teams, and scatter everybody around the capital, literally. And we had to do the old-fashioned way. We called each and every one of our clients. We got all our relationship managers to call everyone and ask them how they're doing. So a month into the lockdown, we could see that our clients were struggling with, paying their trade bills. That was the biggest thing. That was the biggest challenge. And so we had to look into extending trade bills, literally throwing what I would say a lifeline during that time for our clients. Of course, for our people, it's I know the word unprecedented has been overused during this time, but it truly is unprecedented. You usually have BCPs like pilot program BCPs, but here we literally had to move half the team out of the building, and then we realized that we weren't actually readily enabled. We think that we could enable everyone at home, but that wasn't quite the case. So it took us about a month to sort ourselves out, to allow people to work from home, those who had to still come to the office, sorting out with the police, allowing people to come to the office, and essentially working on a repayment assistance program, as we call it, with our clients.
Rajate, you mentioned just now about throwing a lifeline. Can you perhaps expand a bit on that as to what you and AmBank did?
Oh, yeah, sure. I'll give some context to what that means. The country, Malaysia, went into a national lockdown. And it started on the 18th of March to May. So that was full lockdown. We couldn't even get out of our homes. If you wanted to go and get something from the grocers, you could literally only go like one person per household. It was quite comical. If you were to Google it up, you'll see, people sending husbands to go grocery shopping and them not getting it right. So that was really what you say. We went through that kind of lockdown. We couldn't travel between districts. We couldn't travel between states. And since then till today, we're actually still under tiered movement restrictions. So like, for instance, it was lifted and then it is now imposed again. So essentially from March 18 till today, businesses have been heavily disrupted. And giving context to what it had done to Malaysia, you know, our GDP plunged to a record low of minus 17.1%. And this is actually lower than the Asian financial crisis of 11.2%. So we never thought we could get even worse than that. And so the House view is we predict GDP to be at the range of -4 to -6. We're seeing some rebound this quarter, but it's still going to be a full year negative GDP. And the GDP losses, we think is going to be anything between 10 to 30 billion US dollars. What we're also seeing is that industrial output has come down and by 40 to 70% during this movement control order I was telling you about. And there's a huge negative growth in the manufacturing sector. As you know, Malaysia is an export country. We export a lot of manufacturing goods. Electronic E&E is one of the major things we export other than palm oil and crude oil. Excuse me. And jobs losses, unemployment is huge. At the point of print, we're talking about our agriculture and services sector, hospitality sector just completely nosedived, and now of course aviation sector, plantation, F&B. I mean, you guys know it as well as I do, right? You're probably seeing it in your own markets as well. So what we had to do very quickly after the government announced this movement control order, and this was MBank's response was first we had to make changes to our HR policy. We've never had such a thing about allowing people working from home. And those were just BCP tests, you know what I mean? We've never really had to move like more than half of the workforce home. And what we needed to do immediately was also to upgrade these work from home tools and connectivity for our employees. You know, being a bank, we've never really allowed people to have full access, especially to like credit systems, you know, operation systems. We've never had that kind of ability to do that from home. You can work from home, but you cannot access everything. So that was a huge race for the IT infrastructure guys to allow that to happen. And then once we got our people sorted out, then we focused on our clients. You know, we have been promoting the use of digital platforms to our clients for the last, more intensively for the last 5 years. But you know, we have the old ma and pa kind of SMEs who are quite happy to still write out checks and not migrate to digital platforms. And then this happened. So it was during the lockdown that we had to facilitate client migration to digital platforms. And we had to, and some of them literally require us to sit next to them to show them how to click, how to do this. So that was a real challenge in mobilizing the team when we were under a movement control order. We can't leave. So trying to navigate, you know, using web calls was a real challenge for some of, if I would say, the older generation or the more less digitally savvy group of clients. That was a real challenge. So that was one of the key things we did. The other was to actually work on repayment assistance. So we had to provide automatic loan repayment dispensation for all our SME clients. So this was a government directive. For all SME clients, loan payment moratorium starting 1st April to end of September. So 6 months, full dispensation. That in itself was a logistical nightmare because, you know, you have to tweak your systems. You have to go and talk to everybody. And because, you know, just because you're giving them dispensation for the 6 months doesn't mean they don't have to repay after that 6 months. So how's that going to work? How about the interest that's accruing? Is there such a thing as interest compounding? You know, how do we do all that? And the key thing that we worked on was actually on trade bills. We saw this strained on our clients. the inability to make good of their trade bills, or things that they had paid and goods hadn't arrived because the ports were shut down. That 2 months was really, stuff that movies were made of. And that was what we focused on for that first 3 months, and what we're continuing to do until today. So we've ended this automatic loan repayment dispensation, but we're restarting it in October for those who are still suffering, like those in the hospitality industry, those who have lost their jobs, those who have had huge pay cuts, and those in the aviation industry. So we're looking at certain segments to continue with these loan repayment moratorium. So I just quickly want to show you how Malaysia's trade numbers looked. As you could see, when we went into a movement control order, MCO, in March, April, May, we hit rock bottom. So we're seeing impressive recovery on exports, but that is actually not quite reflective of what's happening here. This is actually supported only by the rubber glove manufacturers and oil palm prices. As you know, Malaysia is the world's largest rubber glove manufacturer. So our top 4 rubber glove manufacturers have now beat the top bank's market cap in this country. So you will see that recovery largely comes from that sector and also from oil palm prices. But that's not reflective across industries. So, and you can see even like year-on-year increase, exports are down. So if you take up to where we are today, we're nowhere near pre-COVID levels, except for the rubber glove guys. And so our focus ahead is really to intensify client migration to digital platforms, not just for payments, but also facilitating them to sell their wares online. So we've had some, clients who had brick and mortar stores who were completely caught because they had no online, alternatives. So we've had to move into facilitating that as well. And then the other focus for us is to continue what we dub the repayment assistance program, both by our own initiatives and also that of the government's directives. So really, that's what I have to share with everyone. Thank you.
Thank you, Rajate, for your insights. Now, looking to a post-pandemic world, hopefully soon, Michael, let me turn to you. What thoughts does ANZ have about the future of the post-pandemic environment?
Thanks, Ashish. I think the way we're thinking about it at ANZ is that there's still a lot of moving parts out there at the moment. So if we think about geopolitical risk, we think about a lot of businesses have found that COVID exposed concentration risk in their supply chains, their trade routes. So there's going to be quite a shift there in companies seeking to diversify. And I know Jay's much more qualified than me to talk about the size of government stimulus and what have you, but I can't help thinking how that's going to play out. I have seen stats that the government stimulus is 3 times what we spent during the GFC. I appreciate it's a different type of spend, but I can't help thinking what's the macro risk associated with how that plays out over time. I think we're seeing social trend changes. I feel a little bit insensitive talking about this from an Australia and New Zealand perspective, given many economies are still in lockdown. But Australians and Kiwis love travelling, so they can't do that internationally. So we're seeing a significant growth in domestic tourism. Right, the old family road trip is back on the agenda, and businesses associated with that. Regional property is outperforming the city. Businesses along those routes outperforming other businesses. So interesting changes. Houses are outperforming apartments in the city because with working from home arrangements, people want more space. So interesting changes in social trends happening. I think from a banking perspective, we've seen an acceleration in the demand for automation, straight through processing, self-service, and I guess these aren't new trends, but they are absolutely accelerating trends, and also sustainability is accelerating a lot as well. And when I talk about sustainability, I'm not just talking about the environment. I'm actually talking about work-life balance, community issues, and so on and so forth. So if I take an example, and I think about pre-COVID, where we've been challenged by new entrants to the industry, especially in that international money transfer space, where we saw them enter the industry a number of years ago and consume market share pretty quickly as a result of them having cheaper, faster, easy to use services. It's a really good example of what the requirements of our customers are and that customer experience, and we've responded to that as a banking industry in eliminating rebates, FX share, flattening our FX margins, and making a much more transparent and simple service for the customers. And we're seeing that, we saw it now, I guess, as a result of COVID, and not just purely as a result of COVID, but I would say it really is starting to accelerate more around accessibility and availability, right? That self-service element and the accessibility and the availability of services from a customer experience is becoming so important. So we're thinking about that at ANZ, and that 24/7 international money transfers is a really important investment for us that we're focusing on going forward with linking up Swift GPI to our new payments platform in Australia, and initially focusing on extending our hours for our book transfers initially. And some really good examples of increase in demand and acceleration of that demand in automation and straight through processing is, over the COVID period, we've seen our customers' use of host-to-host connectivity increase 30% over that period. We saw checks drop 20% in a matter of months, as in the volumes, and normally, checks have been falling at about 20% per annum for the past few years. We saw a 20% drop within a few months, and New Zealand have announced the complete phasing out of checks now. And if you go to your local store, a lot of them won't even accept cash anymore. So I think it's quite interesting seeing that acceleration, and I think a number of businesses that have resisted that change in their processes or modernising their processes have come to the realisation that it's now, as a result of COVID, it's not just about efficiency. It's actually you're managing an operational risk and the continuity risk of your business by actually automating and modernising your processes. So when we're thinking about this and all of the changes that are happening in our economy, the macro, the social, and the acceleration in those trends, we're really thinking about it from an ANZ perspective, as in, well, we can't predict the future, so let's focus on investing in our customer experience and preparing our organisation so that we can pivot and shift resources and take advantage of opportunities as they present themselves, or deal with those unforeseen events.
No, those are some great points, Michael. So let me ask, you talked about a bit about customer experience, so perhaps slightly more insights into how is ANZ thinking about the customer experience and the impact to self-service, and how does that translate to a competitive advantage?
Okay. I guess from an ANZ perspective, we're really doubling down on our investment in that self-service and automation space. So, bringing our omni-channel experience to our customers is quite important to us, but it's got to be user-friendly. It's got to be easy for the customers to use. I think Shane, explained it really well. Shane Elliott, our CEO, on a recent webcast, if anyone was on it, and he talked about the 1% grind in transaction banking, right? Where he said, customer experience, or if you like, your competitive advantage is eked out incrementally in transaction banking. It's potentially that 1% incremental improvement in your operations, or the 1% incremental improvement in service, proposition, customer experience, ease of use. But all of these incremental improvements add up over time into your competitive advantage. And I also think, that drive towards automation and self-service, it's a little bit of a conundrum for us as well, because the more we drive towards self-service and give the customers what they need and automate and what have you, the less opportunity we've actually got to interact with our customers. So that feeds into our people strategy around, well, our sales teams have to be that much more highly skilled, because they've got lesser opportunity to interact with the customer, which means they've got to be that much more impactful when they do, right? So those conversations with the customer have to be elevated to a much more value-added level, so that we can actually take advantage of opportunities as we identify them.
So to expand on that a bit, Michael, how do you see, and how is ANZ preparing to pivot and shift with competitive challenge and opportunities and unforeseen events?
Okay, good question. So I guess we see a couple of things. I think I think there's a few different elements that have, I think, helped us position ourselves well. Right. So we've talked about the customer experience element, but as in positioning ourselves to be able to shift, make quick decisions, and actually move resourcing. I see a few elements in there. I think a really strong culture around purpose and values, as well as having a really solid people strategy, is really important to that, and that's the way we're thinking about it at ANZ. I think we've heard today around lockdown. Wells had to migrate, I think it was 250,000 staff in a matter of days to working from home. I mean, we had to do that. We just heard, AmBank, similar story. Prior to COVID, we probably would have thought, wow, could we really do that? Could we really execute on that over a weekend? Which is exactly what we did at ANZ. Our operations and tech teams moved 35,000 people to working from home over a weekend in 34 markets. It's pretty incredible outcome. And you think about the agility and the speed that took place. And traditionally, you think about all of the operational risk reviews and the committees that would have had to have gone through, and the forums and what have you. They managed to do it without compromising on risk, which means that they found a shorter and more pragmatic path to execute quickly. Right? Now, how we take those learnings forward and take them more broadly across our business is something that we're thinking a great deal about. And we do believe that having a really strong culture around values and purpose have really helped people make decisions with imperfect information, right? Because I think from a ANZ perspective, we say our purpose is to build a world where people and communities thrive, right? And that is genuinely used in our decision making around, is this piece of business consistent with our purpose and our values? Is the outcome and the behaviours in the way that we look at this consistent? And I think directionally that helps people make decisions in an imperfect environment with imperfect information. So I think that's been a really key thing for us. Also, sort of moving across into people strategy. making sure that because ultimately, I mean, you can have the best ideas in the world, you can have the best strategy, the best products and what have you, but if you haven't got the right people and you haven't invested in your people, then actually nothing works. So the way we're thinking about it at ANZ is that if we want to be able to pivot and shift and take advantage of opportunities or respond to unforeseen issues that arise, which potentially will, we need people that are versatile, adaptable, resilient, have transferable skill sets, multiple skills that can actually shift from one part of our business to another rapidly, which also supports, the move of capital, resources, credit appetite, what have you, between different sectors and segments. So, and I already mentioned, the need for a more impactful and higher trained and skilled sales team. So while we can't really predict the future and say this is precisely what things are going to look like, I guess the way we're thinking about it at ANZ is how do we make sure that we're well positioned for that future? And I think if you're focusing on investing in the customer experience and continuing to improve that, it's difficult to go wrong there. And if you focus on your people strategy and make sure you've got resilient, adaptable people from top to bottom, then I think that positions you quite well for the future to shift and pivot as necessary.
Michael, you've certainly given us some great food for thought on future people strategy and business approaches to support the broader communities banks serve. So thank you for that. However, as Jay pointed out, economic outlook is very dependent on the evolution of the pandemic. Trade growth may be at a slower pace and will not return back to a previous level in the short term. In reference to trade patterns, Ravi mentioned that it will look very different by 2023, and COVID-19 may accelerate some of those trends that we were going to see in trade anyways. The financial sector is used to crisis, but COVID-19 certainly presented different and difficult challenges. Although not specifically discussed, on the positive side, banks were able to deploy technology rapidly, build upon their prior investments to meet customer demands for digital banking tools. Also, as Crystal and Rajate highlighted, banks adjusted their BCP and client engagement programs during the initial days of the pandemic. Regardless, the landscape will look dramatically different in the future, as companies shift their focus from fighting the pandemic to winning the post-COVID-19 future. Michael stated perfectly that there are a number of themes that will shape banking in the post-COVID era. And the best opportunity is to be clear on the purpose, values, and people strategy. With that, I want to thank our panelists for their insights and participation. And to our audience, thank you for joining, and please stay safe. Let us now take a short break before we go to open dialogue and Q&A for both sessions. As a reminder, please email your questions for the panelists to globalpaymentsadvisorygroup@wellsfargo.com. Welcome to our live Q&A session for day 2. I'm joined by April Fraser, who moderated our first panel discussion on sustainability and corporate responsibility. In addition, I'm pleased to introduce Tom Ducharme, who is Head of Financial Institutions Group at Wells Fargo. Tom, thank you for taking the time to join us for our discussion today. Also joining us is Michael McDowell, who is partner and co-lead in BCG's Global Trade and Investment based in Montreal. Due to time zone differences, he has kindly agreed to step in place for Ravi Hanspal, who you heard earlier during our panel discussion. Thank you, Michael. As a reminder, we request participants to direct your questions to our GPAC mailbox. So with that introduction, let me start our Q&A, and maybe Jay, starting with you first. You talked about the broader economic perspective from a COVID perspective. Could you talk, will the economic upswing many expect in 2020 post-pandemic and with the political changes in US presents its own challenges and opportunities? If I can ask you to talk more broadly from an economic perspective, and then I'll direct the same question to Tom and George more from a business and payments perspective.
Sure. So you talked about challenges and opportunities. Initially, I think there's going to be some challenges. I mean, what we're seeing is just broadly is a little bit of a slowdown. I mean, it looks like Europe right now is going to contract again in the fourth quarter. Things are slowing here in the United States as well. And so the challenge in the near term for many sort of banks is in a weak business environment like that, you could see defaults of business customers start to spike up. You could see payment impairments start to rise as well. But once we get further into the year in 2021 and things do start to pick up with the vaccine, then you're on the other side of that, and that's where the opportunities come. In a rising economic environment, that's usually pretty good for banks. They start to make more loans, et cetera. And also, I mean, you start to get a steeper yield curve there. It's not like the 10-year yields are going to, go out through the roof or anything like that. But as the market starts to get comfortable with the idea of stronger growth, the curve should start to steepen, and that's usually pretty good for banks' profits as well. So near term, I think the overall economic environment is one of a little bit more challenges. But as we get through 2021, I think there's more and more opportunities as the economic environment improves.
Thanks. So to follow up on that, Tom, could you sort of share your perspective from a business and FIG perspective on the same question?
Sure. Thank you, Ashish, and good morning to everybody in Asia, and good evening to colleagues and our partners in the U.S. I think that from a banking standpoint, we're all very optimistic on the good news we've heard and seen recently from Moderna and Pfizer, that they're on the verge, hopefully in the next few days and weeks, of starting to distribute the vaccine. And while that will take several weeks and months to be disseminated, I think we all feel there's a certain sense of optimism looking to 2021 and feeling we can get back to normal, hopefully, in the second half of 2021. I think there is an opportunity for us to achieve more economic normality in the third quarter of 2021. And that is something that all of us, I think, in the financial institution world are looking forward to. For banks, what we've seen really this year is that the capital and the liquidity positions for most banks have continued to improve. And when I look in-house at Wells Fargo, I can speak with confidence that our capital position has clearly improved quarter after quarter. And what we see today is really much more of an income statement recession where the top line and the bottom line have been impacted, but really that the balance sheet and asset quality have remained strong. And that's very visible through the Q3 results of most banks who have not taken more provisions. For us really in the financial institution sector, I think one of the things that we have to come to grips with is the fact that we will be operating with low interest rate environments for the foreseeable future. This really means that we have to focus the business and really pivot towards growing the fee income stream in all of our business lines going forward. And those banks that are more diversified, I think, are going to be more well positioned to really leverage their sales and trading business, their asset management business, and even their transaction banking businesses to really try and pivot and move their businesses to the next level in 2021. So I think there is a sense of encouragement and optimism that we can really count on next year. And I think we'll all be very glad when that happens. Thank you, Ashish.
Thanks. And George, as head of global payments for Wells Fargo, how do you see the payments environment?
Well, really, we're all ears to what Jay and Michael and Tom and Raja and Mike have said to us, because we're really trying to, you're listening to the sound of the street, right? What are people actually doing out there? And how's that going to convert into transactions? Because there is definitely a link between payments and the economy. Payments rise. Sometimes they're the canary in the coal mine. Sometimes they're the caboose. But it's becoming more complicated for us to follow the traces and tracks because of digitization. And as payments and other microservices have been digitized, it's hard to see where, how the economy doesn't translate as easily into the payment numbers as we've seen in the past. What I would say is that we have definitely seen a correlation between the economics globally and payment volumes, particularly when there's a lockdown. There's been a dramatic drop-off in payments to that country when it locked down. What we're not so sure we're seeing is how they're coming back, if it does come back, because of these microservices and the digitization. Just a little bit harder to see through that cloud to what the real economy is doing.
Thank you. So those are some great insights, Jay, Tom, and George. Thank you for that. And I'm sure we're going to come back to this topic and leverage on your responses later in the session. But for now, let me turn it over to April and ask her to see if she has questions for her panel.
Thanks, Ashish. And as we talk a lot about 2021 and what our expectations are clearly coming out of the COVID crisis, also want to spend some time on ESG. It's become a hot topic across the board, especially internationally, and starting to get a lot of more momentum in 2021. So Mary, as we think about 2021, can you highlight what you think the important ESG issues are for companies to manage for going into next year and beyond?
Sure. Hi, April, and good to be here with you all. In 2021, we will expect there to be a focus on companies supporting rebuilding in their communities, particularly those members of the community most hard hit and most vulnerable to economic stress from COVID-19. COVID-19 has also amplified the inequalities that exist in society. And so we will have a responsibility to think about how we create inclusive growth and make sure that all members of society benefit from the return of the economy. And lastly, we know there's growing and will continue to be increased focus on climate change and the role of companies from a capital deployment perspective, from a risk management perspective, and from a collaboration perspective in supporting our communities in addressing the impacts of climate change.
Thanks, Mary. That's extremely helpful. I mean, we've heard a lot about climate change with the new U.S. administration coming on board, as well as from the EU as well, thinking about different ways of thinking about climate change and the impact from banks. On our panel session, we also were joined by Genevieve Pichet. And one of the dynamics that we have is we've created a new ESG solutions group at Wells Fargo as part of the corporate investment bank. Mary, as you think about the dynamics between your team and the new team we've created in CIB, how do you look at partnering together with Genevieve and the different things we're looking to do in CIB going forward?
Well, we're excited that CIB has created the ESG Solutions Center. We think there's tremendous opportunity. We think it's critically important that companies use all of their levers to address these important sustainability and social challenges. So we absolutely will and have been collaborating with the team and will continue to collaborate with the team. We'll provide our expertise when needed, participate in client dialogues, support the business by joining collaborations and working with thought leaders and NGOs that are focused on addressing these issues, and really thinking about where our shared opportunities are, not only internally, but with our clients to really drive a focus on these challenges and issues, opportunities.
Thanks, Mary. We really appreciate that. And we're excited as part of CIB that we have the new ESG solutions and what we can do with the broader sustainability team at Wells Fargo. So Ashish, I'm going to pass it back over to you to continue the discussion.
Thank you. So, shifting from economic perspective to sustainability to perhaps going to trade. And I want to again thank you, Michael, for joining and taking place of Ravi to share your insights. In his remarks during our panel discussions, Ravi talked about how COVID-19 may accelerate some of the trends that we were going to see in trade anyways. Could we ask you to perhaps elaborate a bit more on that?
Sure, thanks. When we look at these trends within BCG, we look at really three elements. How does GDP behave? So do we have an even recovery or perhaps a recovery with some sectoral imbalances? We look at geopolitical forces, and so how is that going? Is there more collaboration around the WTO and the multilateral system, or more sort of economic nationalism? And then thirdly, how do supply chains react to that environment? So taking those three in turn, on the GDP side, obviously there'll be a big sectoral difference and a regional difference as to how GDP recovers, and that'll affect trade quite directly. On the geopolitical front, I think you'll see a continuation of selective economic nationalism. Let's be clear, this economic nationalism we've seen has affected trade pretty dramatically in some pretty narrow corridors of trade, the US-China dynamic being one of the most important ones, but as a percentage of total global trade, even that is a pretty small number. But if you're in that trade flow, it's a pretty big deal. And I think we'll see some selective nationalism, especially around certain commodities that people feel are essential to national security, national well-being, could be sectors in certain technology categories as well. And then the last one is supply chains. I think quite apart from whatever impact the COVID-19 effect has had on the overall trade flows, individual companies with individual supply chains have realized maybe that last incremental little bit of cost I got out of being in one global scale facility in one given country, maybe I should think about maybe more multi-local sourcing. Again, not in every industry, but in certain industries that creates a big vulnerability. So I think we're going to see really a de-averaged response to all this. Our model shows global trade recovering in 2022 to its previous peak, which was 2019. But I think that average really needs to be looked at in a sectoral and regional basis. You'll see a lot of dynamics happening below the waterline there.
Thank you, Michael. Maybe can you talk, and after that I'll ask Jay if he has any comments on the same topic. What do you see in 2021, more near term in terms of trade? Do you see, what levels are you and BCG projecting for next year?
Sure. Well, obviously trade in 2020 will end up being higher than many of us thought, I'd say in the spring and early summer, right? The way the economy came out of the first wave, the way that China in particular was able to get the virus under control and get production back up and running, I think surprised a lot of forecasters, including ourselves. And so I think to the extent that we see a rollout in 2021 of a vaccine in key parts of the world, I think you'll see that support a return to trade in those sectors that haven't been structurally damaged by trade. It may take a while for things like airlines to come back, things like tourism, but in the massive kind of industrial and consumer production, I think you'll see that trade coming back. I think it's important to watch what's going on in the EU with Brexit. I think it's important to watch what's going on in the US-China dynamic as the new US administration looks at how to handle their broader set of challenges, with China, which are not, of course, limited to trade. So I think in 2021, you'll see continued growth on the way back to that kind of historic level of 2019, which we'll see, I think, in 2022.
Thank you, Michael. So Jay, let me ask you, from a trade perspective, could you sort of elaborate your views on 2021 itself, but also in terms of US and China trade relations?
Yeah, so Michael said he thought that global trade would get back to its 2019 peak in 2022, and I would largely agree with that as well. I mean, it looks like global GDP this year is going to contract about 4% or so, and it's probably going to grow maybe 5% or so next year, but that's coming from a lower base. So you don't get back to 2019 until sometime in 2022 in terms of GDP, and there's a high correlation in terms of trade with that as well. In terms of the China-US dynamic with the incoming Biden administration, I mean, our view there is the Biden administration will not reduce tariffs on China, at least initially. I think the rhetoric will come down in terms of trade war sorts of things, but the Biden administration will keep that there as leverage. And I think you will see a thawing of tensions between the United States and Europe, I think the United States and Europe will partner and try to leverage each other in terms of negotiations with China. But again, I don't think you're looking at tariffs coming down, the United States versus China, and then vice versa as well. Again, the rhetoric will be toned down, but we'll still be looking at a world with, I think, some tariffs for quite some time.
Thank you. Thank you, Jay. I appreciate it. So let's we'll stay on the election theme, but switch the topic a bit. So Crystal, you head up the business continuity for Wells Fargo. Could you please share with us how did Wells Fargo prepare for any U.S. elections day disruption in a COVID-19 environment?
Sure. Thank you, Ashish, and hello, everyone. So Michael and others talked about COVID and the impact it's had on technology and digitization, as well as other things like supply chain. And the U.S. election certainly gave us another chance to test our resiliency. So even though the election was on November 3rd, it's really not over until Inauguration Day of January 20th. We have a few events in the middle of December. We have an electoral college casting votes in which all the states come together. There could be some activity there as well. So, when we were preparing for the elections, to answer your question, we really were thinking about 4 primary risks. One was certainly the protest and violence, the risk of that given the summer in the United States and all of the protests and violence that were occurring in our large metropolitan areas. The second was a risk of increased cyber attacks, certainly something that we needed to be sensitive to. We were also focused on market volatility and the risks associated with election results and potentially some prolonged impacts of the election, depending on who won and how things were handled. And then, of course, ultimately, an increased level of customer and client activity. So, I'm happy to say from a markets perspective, in spite of, the uncertainty, the markets behaved in an orderly fashion throughout the week, and, activity was very much business as usual. Margin call activity was well within normal ranges in terms of calls and aggregate dollar amounts per margin call. So, from a financial markets perspective, again, we felt prepared, but happy to say not much activity. From an operational perspective, which is, we did things like we leveraged our supply chain pre the election and got materials to our operating areas to make sure that they were fully staffed with supplies, had supplies on hand, as well as boarding up branches and things of that nature. We made sure that we were ready should we need to respond very quickly. We enhanced our cyber security monitoring, both externally as well as internally. One of the interesting things were, we were also looking at, do we have any internal risks? So we increased that. And then we also looked at our third parties. So those of us who are responsible for, production, including payments, we need to not only think about our internal operations, but we're very dependent on third parties, and we needed to ensure that our third parties were in fact prepared should anything disruptive occur as well. And we stabilized technology changes and really reduced that over a 2-week period. I'm happy to say we were very prepared. I don't want to say it was a non-event because it's not quite over, but we're continuing to monitor, and I believe we'll be prepared if something unfortunate does arise.
Thank you, Crystal. Certainly a lot that you have done and your teams have done, so truly appreciate and congratulations on the efforts so far. So maybe shifting a bit to Raja Tay. Raja Tay, in your comments during our panel discussion, you talked about how did AmBank support the SME and other client segments that AmBank in Malaysia manages and supports. Perhaps could you now talk a bit more about what would be your focus moving forward in a post-COVID-19 pandemic world?
Thanks, Ashish. The thing is, of course, our focus is to continue to support our clients, but there is this challenge between balancing wanting to support them and also preserving capital. So what we have a main focus now is a little bit what Crystal talked about, internal risks.
is we're working really hard on enhancing our existing credit models and to allow for various measurements of credit risks, because whatever we had before just doesn't work in this current environment. And the other thing that's we find challenging is tackling FRS 9. As you know, FRS 9 has onerous modeling and provision implications. So we're kind of right now, because as you may have known, I spoke about Malaysia imposing the auto moratorium on loans, right? So that was free forbearance given to everybody, every SME. So we haven't quite come out of that. We don't know the impact on our asset quality. We don't know whether people are going to be okay because our trade numbers haven't rebounded to pre-COVID levels. Though I must say that we are highly encouraged. The recent 11/11, the Singles Day, we beat last year by like 3-folds. And the drive towards digital solutions in managing cash has just also intensified. And in the last few weeks, we've gotten mandates that, you know, we had been trying to pitch for years, and people kind of fell in deaf ears. So our focus now is really to facilitate our clients' ability to manage their cash digitally. And for the smaller guys, you know, the ma and pa, who were really check writers and cash handlers, we had a brief window when the lockdown was lifted, and there was a rush for everybody to, adopt, you know, just simple cash management systems that they weren't willing to look at before. So we're focusing on that. And of course, continuously trying to help with forbearance and extension of loans. And so the central bank has stepped in as well. They have reduced the statutory reserves. So liquidity, to help with liquidity, interest rates very low, and it's not something that we're used to in Asia at all, right? So it's really it's a real challenge. But I'm hopeful, a little like Tom, although we don't think we're going to bounce back by mid next year, because most of our clients say that it will take years to regain that kind of financial security. Most people say they don't think they're going to want to step into a plane until the whole wide world is vaccinated, for instance. So we think that maybe mid-22 would be where we're looking at levels to return to.
Again, congrats. You know, incredible what you said in the panel, what you did for your clients, and what you're planning for is just tremendous. Again, congratulations. Mike, let me shift to you. You spoke during our discussion how ANZ Bank, you know, is planning for the future from a post-COVID environment. Perhaps I can switch the question and ask you this time, what were your priorities, what have you been your priorities during COVID, and were there any lessons learned where you had to adjust for the path forward?
Sure. Thanks, Ashish. I think we've heard that there were so many things to do, you know, during that COVID period. I think one thing that, you know, I would say that, you know, we're very proud of at ANZ and quite proud of our leadership team was the absolute priority, and it was stated very clearly, was the safety and well-being of our staff and customers. And pretty much everything else flowed from that. I mean, communication was absolutely key as well. And I think, you know, in those early days, as you know, the pandemic was, if you like, gaining momentum, and that uncertainty and anxiety was increasing amongst staff and customers, with, you know, schools closing, you know, people had elderly parents at home, long commutes to the office, you know, what have you. I think the communication from, you know, Shane Elliott and the leadership team with all staff calls every week, and the absolute priority around the safety and well-being of our staff and the mental health of our staff through various initiatives, ongoing calls and communication was absolutely key to the way we managed. And helping our people, we've always embraced flexible working. So, bringing that to the fore and helping our people manage the anxiety and the uncertainty of what was happening, I think, as well as obviously, looking after their families, trying to keep the business running, really put us in a good position through that period. And we, like every other bank, have a number of initiatives and arrangements to support our customers, and that was absolutely key to us as well. But I think helping manage that staff anxiety and focusing on their well-being absolutely flows through to the customer experience at the end as well, and having an engaged staff that is focused on the customer. And absolutely, the staff engagement is actually the highest it's ever been, which is fantastic. So absolutely, well-being, staff safety, and that communication, really helped us through that period.
Well, that's great to hear that you've been able to so successfully get the staff engagement in such a tough environment, and it speaks to your institutions and your work. So thank you for that, and thank you for sharing. Let me quickly ask Nele, who's moderating our mailbox, to see if there are any questions.
Yes, yes, Ashish, we have a couple of questions. The first question is for Rajate. So referring to migrating client to digital platform as part of the measures taken by AmBank during the pandemic, do you think the trend of digitalization will continue post-COVID? And the second part of this question is, what is AmBank's strategy around moving physical branch network to virtual banking channel in the future?
Hi, Nelia. For the first one, yes, I absolutely am encouraged. I think this trend is going to stay because we've had some 75% of Malaysia's SME are really small micro SMEs. And we have been trying to get these guys to move away from cash and checks for the longest time. And they were just so reluctant to do so. But because of this, they were forced to just learn how to use the computer, click, make payments. And 9 out of 10 actually say, wow, I didn't know it was that easy. And oh, it's actually quite difficult for people to steal my money, and that my payments is actually safe. I said, it's a lot safer than you lugging cash in a biscuit tin, which they actually do. And so we think we're seeing the older generation who started this family business is saying, this is great. And the second generation who are more familiar with the use of digital devices, we think this is just going to go, this is going to stay. And we are hoping that we'll be able to rope everybody in, because we have a cashless agenda in the country. And the central bank has already said that they're not going to print any more new notes. So we hope that this is going to go. On our branch network, it's always a very difficult conversation. You still have a board of people who still feel that you need to have physical branches for presence sake. So what we've done and what we're going to continue to do is not keep everything, and also recalibrate how the branches are, make them smaller, make them less operating people sitting in there, making branches truly sales focused and not transactional. And that, I think, is our key part, so that people don't come into the branches to do transactions. They come to speak to a salesperson to get a product or a service. So that's our plan for the next 3 years.
Thank you, Rajate. Nele, what was the second question?
Yes, so second question, I think it's directed just to the panel. It reads, the COVID-19 pandemic has impacted heavily local retail and consumer businesses, such as aviation around the world, and we see huge changes in terms of business models on the cross-border activities. Do you see signs of a weakened demand for US dollars as a cross-border payment?
So Jay, maybe I'll direct that to you first and get your views, and then perhaps anybody else who wants to jump in and have a comment.
Yeah, so, in a very long-term sense, I think the use of dollars in terms of, in a relative sense, will decline over time. I mean, there are other substitutes for dollars, be it euros or be it cryptocurrencies or whatever. But it's not like the U.S. dollar is going to fade away. I mean, one of the reasons why, probably the most important reason why the dollar is still the predominant currency or reserve currency in the world is the deep and liquid and transparent capital markets in the United States that are still based in dollars. There's no other economy in the world that can boast of the transparency, the liquidity, and the depth of the capital markets here. So over time, will more transactions be done in currencies that aren't U.S. dollars? Yes, that will probably happen in a slow, steady sort of pace. But it's not like the U.S. dollar is going to fade away, very, very quickly.
Got it. So Jay, let's remain on the economic theme. Any views on the next 4 years economic policy implications post-U.S. elections?
Right. So given what happened here on November the 3rd and what continues to happen, it looks like you're going to have divided government. Joe Biden will be the president of the United States. He's probably going to be facing a Republican-controlled Senate, very narrowly, but that's probably what he's looking at. So you're probably not going to see any major fiscal initiatives get legislated here. Probably not going to be any big tax increases, but on the other hand, you're not looking at trillions of dollars of spending. The areas of economic policy that the president can figure out or do by himself would be on the trade front. And I already talked about our views there in terms of China trade. We don't think those tariffs are going away anytime soon. And also on the regulatory front. The president has a lot of authority when it comes to regulation, and that could have some implications for banks. At this point, it's still too early to know exactly who we're looking at on different cabinet posts, which would be important in some of those regulations. Although I would say that his pick of Janet Yellen as his Treasury Secretary, I think is a fantastic pick. She obviously has a lot of experience being the chairman of the Federal Reserve, chairman of the Council of Economic Advisors. She will be, I think, a very, very good Treasury Secretary. So important there, but we'll see what happens on the regulatory front, depending on who he picks for other key cabinet posts.
Got it. Michael, from a BCG perspective, do you have any view, in a post-U.S. election environment, whether it's on trade or general economic?
Right. I think one point on the trade front that we didn't emphasize in the earlier conversation was just, we talked about a change in rhetoric and a tone, particularly with China, but the one consistent theme that you've seen through the campaign, including spontaneously in the presidential debates, I might add, and also in some of the statements that the president-elect has said in his press conferences, is about the U.S., working more closely with allies so that America first doesn't mean America alone. And so I think you'll see people referred to a diminishing of tensions with Europe. I think that could be also said for Canada and Mexico that have had their fair share of difficulties in the past few years. And I think also with respect to certain partners in the Asia-Pacific region, especially Japan, I think you could put in the forefront of that group. So I think that could change the dynamic. It doesn't necessarily make it easier for those countries, because I think the ability to sort of stand back and let the U.S. hit you while it's hitting others will be less available as you start to see more coordinated efforts on the international trade front. And I think domestically, the other theme we see at BCG is just this focus on kind of a modern industrial policy. So it's not about, protecting the industries of the past and bringing back some former glory, but actually getting ahead of the industry of the future, whether those are things like green tech or artificial intelligence or other data-based industries. And so I think you can expect more focus on those types of industrial policies rather than a more traditionalist approach that you might have seen a generation ago.
Thank you. Jay, one last question for you. Any implications that you see of higher debt levels as a percentage of GDP?
higher debt. I don't worry, Ashish, I don't worry about debt right now. We're in a very, very low interest rate world. I think that's going to continue for the foreseeable future. So governments around the world have the ability to finance the deficits and the debt at very, very low interest rates. What concerns me a little bit more is at some point we will be moving back into a normal sort of interest rate world. Not saying that's going to happen, in the next year or two. But as that happens, if the deficits don't start to come down, governments are going to start to see higher and higher interest costs. That's going to freeze out other sorts of spending that they can do. And in some cases, could actually start to lead to financial market volatility and tension. So, in the short term here, next year, 2, 3, I don't really worry about it. But further out, if the governments don't take steps to bring down some of their deficits, I think they could be really looking at some issues at that point.
Yeah. No, thank you. April, let me ask any question or any comment that you or Mary have before I turn it over for one last question and then have George make his closing remarks.
Yeah, maybe one final statement I did want to make is going back to one of the comments that Jay made regarding we don't know what's going to happen on the regulatory front with the new elections and who could be in those seats. That's something we're watching very closely in the banking sector. It really could define the regulation of the banking industry once again. Coming out of a crisis, we know coming out of the global financial crisis that the regulators are going to review all of the liquidity and capital dynamics of the banking industry. I think what's really positive is, as Tom mentioned at the very beginning, all the banks came in with a lot of strength on capital and liquidity. But with having new individuals that could come into the regulatory body in the US, it is a question mark that we're going to have to watch very closely of what it could mean for the banking industry in the US. And the rules that potentially could be adjusted and shifted over the years to come. So we're going to continue to watch that very closely. And maybe my final question to Mary would be, as you think about, the new administration coming in, where do you think the focus will be either on climate change or ESG as we look into 2021 or into the future with this administration?
So I think the Biden administration or incoming administration has very clearly signaled that climate change will be a priority for the administration. They've named Kerry as the climate czar, a very well-respected elder statesman in this country, which really, I think, amplifies the priority of the role and the issues. They've also indicated that climate change won't just be, an EPA or environmental protection issue, that they're going to really embed a focus on climate across the agencies, transportation, commerce, HUD, and really think about how to drive, as someone said, the green infrastructure and green technology investment. So I anticipate plenty of discussions, plenty of opportunities, and a high priority on those issues from the administration.
Thanks, Mary. That's extremely helpful. And I think that's something there's a lot for us to be watching for in 2021 globally from a COVID dynamic, but as well as when we think about the US and the changes that we could see. And it does feel like the US is really starting to step up across the board on ESG and, start to catch up a little bit more on the international front that we've seen of late. So I think that leaves it with me tonight. Ashish, I'll turn it back over to you.
Thanks. So maybe I can just ask one open-ended question for anybody to respond. It's really around our business is about relationships. It's about customer experience. It's about how we engage with our clients and with our team members. How do you see, given today's environment and going into next year, how are you connecting and remaining connecting virtually with your clients, and how you see that digital strategies for you to remain engaged with them?
So maybe Ashish, I'll kick it off and then would love to hear from others as well on the panel. I think as we look at it as, we're relationship managers and our goal is to be meeting with each and every one of you out there in the market. And it's definitely been different. I think it's been amazing to see how successful we have been over the last 9+ months, using all of the virtual channels that we have from Zoom to WebEx to all the different areas. But nothing really replaces seeing each other in person, being able to have the personal dynamics of dinners or coffees or lunches. And I don't think that's going to change. I think what will change is we will be more efficient. I think as I think about my own personal travel and being the head of global banks, is I'll still need to be at every single region, but I think it'll give me the opportunity to go to more regions throughout the year versus needing to go to regions multiple times and using the virtual channels when I'm not able to be in the markets. And we'll look to all the relationship managers to do the same thing, if anything, I think we can have more connectivity where we're able to see our clients in person, but also be able to see them virtually as well throughout the year. So I'm looking forward to the changes that this is going to bring, but it really doesn't take away from the conferences, being able to do GPAG Live like we've done every single year, and having our events in the evenings where we get to have the side talks. It doesn't replace that. It doesn't replace SIBOS or IMF. I think we all miss those opportunities, but I think it has taught all of us that we can be more efficient with our time and stay even more connected than I think any of us really thought we could. But maybe Tom, turn it over to you for some thoughts.
No,
on your time.
That was really well said, April. And I would echo that. I think the expectations over the last 8 months have probably exceeded mine personally in how well we've been able to stay connected internally, but also with clients externally. And one of the small side benefits, I think, with client connectivity is that everybody's been available because we're all at home and you can jump on the phone or on a Zoom call very quickly and are not on the road or in an airport. So I would expect a lot of this to kind of stay part of how the business model will evolve in 2021. I think even when we can travel again, I think that we'll be challenged and question when we should get on a plane, what trips we could make, and how we can continue to use this kind of new technology that's readily out there. I think at the end of the day, relationships are important, so we'll have to make a concerted effort to get back and connect. And I look forward to that personally and professionally on many fronts.
If I could just add, for a start, I'm speaking a lot more to my counterparts in Wells Fargo than ever before.
That's good.
I used to only speak to maybe, the representative down here in Singapore, but now I'm speaking to all of you in the US, and I'm actually able to put faces to names. So I think this is great.
Yeah,
well, thank you.
I'd echo that. I'd echo that, Ashish, as well. From an ANZ perspective, I mean, I've got just about every video chat there is, from Zoom to BlueJeans to WebEx, and I think probably one of the benefits, if we think about, the last 6 months has been, how, I guess the downside has been it's all the work without the fun, right? As April was just saying, there's no dinners, there's no face-to-face, what have you, But I think on the flip side, it's really humanized a lot of our relationships, right? So you've been on video, there's dogs barking in the background, or there's, kids running across the back of the screen, or something's happening that's, quite funny. And I think that's only strengthened relationships.
Well said, well said, well said. So, Crystal, are you ready? We are going to be doing a lot more video. So from a BCP perspective, you're ready for all the bandwidth and that we're going to demand from you? And
yeah, so believe it or not, we are very aware of the single points of failure across our internet providers, our electricity providers, our phone providers, et cetera. We do a lot of monitoring and have adjusted for it. And I would say, we'll be ready. Certainly. And, honestly, we're looking forward to getting colleagues back to the office, which we will do in a very safe and, closely managed way, right? Employee safety is absolutely at our top concern, as others have said as well.
Well, you, George, and Mary would be happy to hear this. But today, because in California, we have this rolling power outages just because of the fires we've had. So today I lost power at my home for 4 hours. But fortunately, and George had put me on this, is I had put those Tesla power walls. So I didn't really realize that I was out of power until they send a notification that you're out of power, but you're operating out of batteries. So at least, Crystal, I can tell you, and George, I was able to recover on my own.
There's no question there's been a climate benefit from the decline in travel. No question.
Absolutely.
Exactly. So, with that, George, before we close out, maybe ask you to make any concluding remarks.
Well, I guess, first of all, mine won't be as broad as April's and Tom's, since I'm just the payment person here. But a couple of things, that were important to me was, first of all, I was looking for canary in the coal mines, and I think I heard a ton of birds. I was glad to hear that the focus remains on people and communities. No matter what we do or how we're doing it or where we are, people and communities seem to be the root of what we're trying to achieve and making them better. So that's always good to hear. I will never forget that rubber gloves are a leading indicator. Raja. So I'll follow up on that from now on. And Michael J. and Mike, thanks for the comments on the economy. They certainly resonate. And you know, for us as payment and the payment side, we're always looking for ways to find correlations between what's going on in the economy and what's going on in payments. And we think we've seen it, and listening to you, it makes it think that. So the one kind of odd thing that's out of tune is that the SWIFT messages that are related to trade are down 14 and 20% this year. So something's happening in trade, supply chains. It's either digitization or a truly dramatic fall off, or the versatility of supply chains. But I'm certainly enlightened. And Crystal finally reminded me of how much work it took to make BCP BAU. Boy, oh boy.
Absolutely.
So, but congratulations to all of you. I mean, it just was so much fun to listen to, and so much spirit and depth, intelligence, and a focus on what matters most to people. Thank you.
Well, you know, on behalf of April and myself and everybody else from Wells Fargo, we really want to thank everybody on the panel. I know some of you did double duty with our sessions for the Americas and EMEA, and then for APAC this evening, and it's getting pretty late for those in the East Coast, so truly appreciate your commitment and engagement here. I also want to thank Nele for helping us with moderating the questions that we got from the participants, and I also want to acknowledge Robert Lin and Jimmy Lee from our payments team in Hong Kong, who have been instrumental in working with our clients, helping promote the GPAC event. Again, want to thank everybody, particularly Mike, Raja, Michael, Mary, Tom, Jay, Crystal. Truly appreciate it, and above all the participants who have been watching us, our panel discussions and this Q&A. So with that, April, and any final words, and thank you on both our behalves.
Yeah, just thank you to all of you for being a part of this from the panel, but as well as our clients. We really appreciate every single one of you. We hope all of you are staying well and are able to take some well-deserved time off at the end of the year, and we're looking forward to continuing to work together in 2021. So thank you.
Thank you. And as a final reminder, for those of you who are going to join us, and hopefully you do tomorrow, our theme is really around digital transformation and technology as an enabler. We do recommend one of the sessions that we have put up on the agenda that was moderated by George to please have that session watched ahead of the sessions tomorrow. Again, thank you so much.